Okay. Oh, good morning, everyone. Here in person, at the right, Villa Ruspoli. Yes, you're lucky, you are in the right place for the third day of the conference, and who is remotely connected with us. Welcome again for the third and last day of the third BABEL International Conference in cooperation with EBI. A stellar lineup. We are late. The word. I'm leaving the floor to Escolar. Please remember where to take the mic if you don't use it. Here. Okay? Thank you.
Dr. Fabio Araújo is an economist at the Central Bank of Brazil focused on digital currency initiatives. His work includes research on developing and implementing CBDCs in emerging economies and their implications for financial inclusion. He is leading the DREX project. Dr. Helmut Elsinger is a financial stability expert at the Austrian National Bank. His work focuses on stress testing methodologies and the implications of digital currencies for financial stability. Dr. Miguel Fernández Ordóñez is an economist and former governor of the Bank of Spain. He brings extensive practical experience in monetary policy and central banking to discussions on the future of digital currencies. Dr. Gérardine Escolar is Deputy Secretary General of the Permanent Bureau of the Hague Conference on Private International Law and head of the International Commercial, Digital, and Financial Law Division. Her work focuses on central bank digital currencies, digital tokens, and private international law implications related to the digital economy. Dr. Marcello Miccoli is an expert in international financial systems at the International Monetary Fund. His work focuses on the global implications of digital currencies for monetary policy and financial stability from an IMF perspective. Professor Bitange Ndemo is the ambassador of the Republic of Kenya and former permanent secretary of Kenya's Ministry of Information and Communication. His work focuses on digital transformation in emerging economies and the potential of digital currencies for financial inclusion in Africa. Mr. Panagiotis Papapaschalis specializes in CBDCs, cybersecurity, FMI law, and central bank banking law. At the European Central Bank, his work focuses on developing the digital euro and its implications for monetary policy and financial stability in the Eurozone. Dr. Arthur Rossi is a banking expert working on financial innovation at the Saudi Central Bank. His work focuses on the implications of digital currencies for Islamic finance and the Middle Eastern financial system. Dr. Sandra is the Deputy Governor of the Croatian National Bank with expertise in monetary policy and market operations. Her work on digital currencies include examining the implications of digital currencies on monetary policy making and issues related to the introduction of digital currencies for small European economies and new Eurozone members. Dr. Marino Vollenweider is an expert in international banking regulation at the Bank for International Settlements. His work focuses on developing global standards for digital currencies and their implications for financial stability and cross-border payments.
Great, thank you very much, and a very good morning to all of you joining us for the third day of this absolutely fantastic, inspiring conference. As you've seen from this very dynamic presentation, my name is Gérardine Escolar, and I am very pleased and privileged to be the moderator of the Roundtable here today. I've been saved from butchering the names of my very esteemed panelists. And so today, Before we go into the roundtable, being the last day, allow me to thank our organizers, the University of Florence, in whose beautiful building we're in, the European Banking Institute, and in particular, the team that is led by Professor Filippo Zatti, Professor Rosa Giovanna Baresi, and very, very ably supported by Chiara Ferri, Dr. Ferri, who's the thing that I think, who's the person that makes everything go, I think. So thank you very much for this opportunity. Now, this roundtable is called Charting the Course, Collaborative Strategies for the Future of Digital Money. And we have a lot of expertise around me, so without further ado, this roundtable will explore the evolving digital money landscape and its impact on legal tender, monetary sovereignty, and policy coordination. Now, we will hear practical insights, proposals from the leading voices across central banks and multilateral institutions, as well as academia. And it gives me great pleasure to perhaps start with Dr. Araújo, Dr. Fabio Araújo online from the Banco Central do Brasil. And maybe just to go to him and ask him about Brazil's DREX model. Now, Dr. Araújo, how is Brazil's DREX model reconciling innovation with the preservation of monetary sovereignty? Hello and welcome.
Thank you, Gérardine. Thank you, everybody, for the invitation to talk in such a group of experts. And I think that reconciling innovation and the preservation of monetary sovereignty, or the preservation of the tools necessary for the mandates of the central bank, is always very challenging. And I think that the key aspect, just to keep it short, the key aspect to tackle that is that central banks should try to contain themselves to the infrastructure level in providing platforms, in providing a way level playing field for all the parties to participate and to build services on top of that. Then in DREX, what we have as the strategy there, we have divided the platform that we are creating in the wholesale level, where the central bank money is the settlement tool, and on a retail level, where commercial bank money or e-money or even stable coins, suitably regulated stable coins, could play the role of the settlement tool. Then I think that when you work together with the markets and think about the solutions or digital money solution or any other infrastructure that the central bank is providing as a digital public infrastructure to give access to all the parties in the market, you maintain the innovation because you open the market up for the entry of new parties, and you maintain the tools necessary for fulfilling the mandate of the central bank: monetary sovereignty, monetary stability, and fiscal stability.
Thank you very much. And that's a wonderful introduction, Dr. Araújo, to a big economy's approach to digital currencies and to handling innovation in line with some more considerations that fly closer to sovereignty. I wonder if we have Ambassador Ndemo online. Unfortunately, he's not joined us yet because we were hoping to get also Kenya's, of course, input to that. But while we wait for him to connect, perhaps, I'll then turn to my colleague on my right, Dr. Arthur Rossi. Just building on what Dr. Araújo has said, would you share with us what lessons are emerging from CBDC experiments, cross-border ones in particular, and how are they shaping regional collaboration? So hopefully we build on what's happening in Brazil and the region, and we hear again from the ambassador, then from his region as well. Dr. Rossi, please.
Absolutely. Thank you very much, and thank you for the flawless organization of this event and this beautiful venue that we're in today. If I had told my boss that my intervention will be in a villa, he would probably have been, So let's move on to the lessons of cross-border CBDC. If you take a step back, you will see that typically central banks do not start their journey with cross-border CBDC. They will typically start with local CBDC experiments, and in fact, they will start with wholesale CBDC experiments. Why? Because with the evolution of central banking have removed themselves from providing services directly to the people, and therefore, the typical counterpart of a central bank is a commercial bank. Therefore, it is a lower hanging fruit for central banks to start with wholesale CBDCs. And therefore, after the first wave of local wholesale CBDCs in 2016, what we've saw is, especially after 2018 onwards, projects that aim to link those different wholesale CBDCs together. And this is one way to do cross-border wholesale CBDC. The other way is to have a platform where you issue, where you transact, and where you redeem this wholesale CBDC. Those two models have benefits, and I'd like to draw a comparison with Target in the EU. As you know, Target originally was the linking of the RTGSs across the EU. Why? Because it was simply easier to do than a whole platform. Well, it's pretty much what happened with a cross-border CBDC, if you think about it. And so the benefit of linking wholesale CBDC, local wholesale CBDC, is typically that you do not have too much complexity, because what you do is you leverage the different wholesale CBDC experiment that you simply link together. An example recently is UBIN CEDAR Plus, where they had settlement time of 30 seconds. 30 seconds, if you compare to T+2 in the Forex market, is a huge advancement. However, if you look at the second approach, which is to have a platform for cross-border CBDC, the settlement, if you look at Enbridge, for instance, is simply instant. Okay? The difficulty, however, is that the complexity of having a platform for wholesale CBDC is higher. In the context of Enbridge, you need, for instance, two sets of agreements. You need an agreement for central banks to interact with one another, and in every different jurisdiction, what you need is a second agreement between the central bank and the participating commercial banks. And therefore, the question really is the additional benefit of a platform for cross-border CBDC warrants the additional complexity? Thank you very much.
Thank you for those insights. It's actually quite interesting, because when we're looking at CBDC experiments, and as Dr. Rossi quite correctly pointed out, a lot of the first stage experiments focus on wholesale. And I'm wondering now, in relation to such experiments and pilots, I mean, we go then to emerging open economies, and really looking at Dr. Sandra Svalcek, in terms of small and emerging open economies, such as Croatia, for example, what challenges would Croatia face due to the rise of private digital currencies in relation to CBDCs, and what measures were put in place to perhaps help protect monetary sovereignty? Welcome, and you have the floor.
No, it's better? Yes. Okay, great. I'm coming from Croatia, and actually Croatia cannot be considered anymore as a small, open, emerging economy as far as it goes to the monetary system, because it's part of Euro system, Eurozone, and shares all the characteristics of the Eurozone. However, I can try to talk from the perspective of small, open, emerging economy, because I have still fresh memory from our past when Croatia was assuming its independent monetary policy and was open economy and emerging economy. So I'll just start with the fact that I think that the basis of the monetary system is money as a unit of account. And actually all the other functions of money are derived from this first role of a unit of account. And it is the central bank, the monetary policy that is providing this, the money, this primary role. And Croatia, unfortunately, has a very rich experience with money that could not assume the role of the unit of account. So I'm not that old, however, I have a rich experience with very poor role of the monetary authorities and a poor role of money as a unit of account. So in my life, I have experienced 4 currencies. First, there was Yugoslav dollar, and I still freshly remember dollar dinner. I still remember for 2 denominations of dinner because of the high inflation. So firstly, the 4 zeros were scrapped and then additional 2 zeros were scrapped. It was a major source of confusion and source of the loss of trust in domestic currency. Then we have introduced Croatian dinar as a transitory currency. And in 1994, we have introduced kuna, and just 2 years ago, euro. And it is very interesting that due to the very strong and rooted fear that the money can lose its value, during that period with the dinar, with Croatian dinar, the trust in money has been lost, and it created all sorts of problems. So first of all, the currency substitution, because Croatia was heavily demarkized and then euroized economy. First, the currency substitutions led to the difficulties in assuming independent monetary policy. So the maneuver space for the monetary policy was very limited. And the second, it actually had very devastating effects for the economy because the payments were delayed. We had so-called illiquidity, but that was just a postponement of payment, and it really ruined the economy. And in spite of the fact that the kuna was stable for almost 3 decades, it could never regain the role of the unit of account because all the time we were faced with the currency substitution, and our money could not assume the role of the unit of account. I'm saying that because we had to revert to another currency, and that is euro, to save us from currency substitution, in spite of the fact that there was no inflation anymore. So I'm talking about that because there is a hidden potential in private digital money to provoke the currency substitution, especially in emerging economies. And there, in that characteristics of private digital money, I see the biggest fear for the emerging economies.
Thank you very much. Can you hear me? No, yes, thank you. Thank you very much for sharing that. I think the very poignant recollection of the importance of trust, I think, public trust in the currency, is something that we take for granted in many economies today. Which we actually can't. And when we go into the digital age as well, it might be something that we need to rebuild in the digital forms of the currency that we already know and love, actually. But thank you so much for sharing that, Dr. Spelček. I think that's a wonderful segue. Perhaps to hear then from Dr. Panagiotis Papapaschalis of the European Central Bank. And of course, as you know, the wonderful project, the digital euro. And I suppose the question there will be, how does the digital euro aim to maintain trust in sovereign money in an era of programmable, decentralized alternatives? And will its legal tender status, actually help? Panos, please.
Thank you very much, Chair. And thank you to the organizers for this beautiful room and this amazing conference. Obviously, everything that I'm saying is in personal capacity. Everything that is right belongs to the decision-making bodies of the ECB. Everything that is wrong is mine. Before the how, I want to briefly speak about the why, and briefly because the Deputy Governor nailed it. It is okay to pay with Bitcoin if any sane person would actually do it. But when the price begins to be quoted in Bitcoin, then we have a problem, because unit of account is an attribute of sovereign money, and loss of a monetary anchor means erosion of the monetary policy stabilization mechanism. And this is why the digital euro needs to remain topical in and fit for the digital era. The why out of the way, let me start answering from the end. Legal tender, will it help? Well, to begin with, the digital euro will be legal tender, and it will carry the full faith and credit of the Eurosystem balance sheet. Contrary to what I've heard yesterday, I do not believe it would make sense for a central bank to issue a non-legal tender CBDC, because that CBDC would need to be convertible at par with legal tender cash. Now, as legal tender, the digital euro will enjoy mandatory acceptance at full face value for the discharge of payment obligations. Merchants accepting digital means of payment shall also have to accept the digital euro. However, as Professor Gortsos explained during the first session, given the relativization of legal tender witnessed in past years, mandatory acceptance merely means that the payment service user will have an option of paying with digital euro or not. In legalese, jus eligendi. Now, thank goodness I'm only a lawyer, I'm not a marketing expert, but I really do not think that the arcane notion of legal tender alone will convince my post-adolescent godchild to swap tapping her mobile phone on a POS for the digital euro. So uptake will inevitably boil down to the product proposition and the user experience related to a future digital euro. And this is the how. As with cash, the digital euro will be a means of payment seamlessly accepted throughout the euro area and beyond. It will be conducive to privacy and data protection. Why is that? Because the euro system neither has the competence nor the desire to process citizens' personal data for commercial purposes. It will also be based on novel cutting-edge technology, updated regularly, and to the extent feasible, function through open standards. That means it will foster innovation by the private sector. Programmability will be part of the private sector innovation. Payments with digital euro will be programmable, that is, PSPs would be allowed to attach added value services. However, the digital euro itself will not be programmable. That is, its intrinsic value would not depend on external events. And this is obvious if one considers the digital euro has to maintain parity of face value with cash. Cash cannot be programmable. And last but not least, and I think this is very important in the current geopolitical conundrum, the digital euro will be always available, at least in its offline variant, even when other private means of payment become unavailable or jeopardized. Thank you.
It's actually quite interesting what we're looking at here this week. The movement, maybe the historical perspective of what we have, this thing. I use thing carefully because there are property lawyers in the room, but this is thing that we call money, and what is the point of it, and all the privileges that we attach to it. So I think we perhaps then will impose on the expertise and experience of Dr. Fernández Ordóñez, on my left, on the matter of what are the principles, the core ideas that should guide regulatory and legal framework changes in the system of money, considering payments and finance, looking back and also perhaps in the coming years. Perhaps we'd love to hear from you.
Okay, thank you. Thank you, Filippo and Rossa, for inviting me, not just to talk here, but because I have learned a lot from all of you. And I have to apologize because you are interested, as I myself, when I had responsibilities in the present. and I am interested only in the future. I don't know if this will be useful for you, but and answering your question, Gérardine, I think the future of regulation is free market. It's dismantling the monopoly we have now. We have now the most protected and intervened sector of the economy. Once China decided to introduce free market, we have introduced free market in many sectors, telecommunication and so on, but the most protected sector is not agriculture, it's banking. It's incredible, the amount of protections and privileges that have the banks. And the problem is that one of the problems of the banks is the fragility of deposits. The deposit is not money, it's a promise to pay money, and then it could fail. And then to solve these problems, since started the state introduced a lot of protections to avoid of deposits. In 19th century, lender of last resort, Roosevelt. And it's okay, no? You didn't hear me? Yeah, excuse me. And continuously, I mean, we had the crisis of Silicon Valley Bank, the regional banks, and then that night the Treasury, FDIC meet, and they decided three things. One, increase the warranty of deposit to the infinite, and to insurers and non-insurers. Second, increase lending facilities. Well, we don't have enough lending facilities. They decided one. And the third one, we changed the accounting standards. Incredible. Because they could not lend if they use the market value of and then decided to accept that the value of the collateral was not the market, but the amortization. Then one colleague in the Bank of Spain told, if we have allowed during the crisis, because I had to help my government to lead the crisis, that we could account as with the amortization of mortgage, we will never had a crisis. then that's continue. And then the Credit Suisse had received 100,000 million euros from the state and from 40,000 million euros from the Swiss state and 100,000 euros. Then well, the idea is that without the state, the banks could not survive. Man, that is the idea. They have a tremendous monopoly in payments or monopoly. You cannot make any payment without using a bank account. You could do PayPal, many things, fintechs, but all with deposits. And then in finance, they cover in Europe 75% of the financial assets are provided by the banks. Then we are discussing if we should increase the capital market union that is, the capital market that is 25. No, and then we are going to change regulation. No. The simple thing is to destroy the monopoly of the banks and the market. You have 100%, everybody. Then is the solution of stimulating shares, private equity, and so on, is not to give the power to the banks that, of course, with the easy privileges, they could cover that. Then that's why it's the future. I mean, it's not, nobody, I think, is interested in destroy the monopoly of the banks in the next week, because the opposite, I mean, I understand, I had responsibilities. If I were an active central banker, I would never had this speech, and I would never say we'll do that. I would say what they say, no? We have to do the things, but maintaining the current system, no? I mean, do not harming whom, do not harming the banks, no? Okay, no, is that. Then that's why I think, and why I think the free market is the principles to solve this. Because we are living in a fascinating situation with technological progress, similar to industrial revolution. And then what you see is that to get the profits of the new technologies, you need to allow innovation. And if you don't have competition, if you don't have free market, you don't have innovation. It's impossible. Then only if you see now our society is transforming with digitalization. If you see the sectors that had free market, because they didn't have a special regulation, like for instance, photograph and video, digital. Well, the transformation has been enormous. I mean, now it's free for everybody, for poor people, to have a video to send with WhatsApp other innovation, the migrant in Spain to Ecuador, and so on. Then massive inclusion and so on. Why? Because that sector were not, they had not monopoly. Kodak didn't have the monopoly. Then the introduction of digital photography and video, other newspapers, the newspapers they didn't have, and the newspaper, the media communication has transformed enormous. Then, but those are, or travel agencies are now for all people and rich people, but everybody make all the, but the problem is the sectors that have monopoly of protections. For instance, telecommunications. We did that at the beginning of that century. And thanks to the liberalization of telecommunication, we have the iPhone and we have the WhatsApp. If not, we would never have that. Then, when you have a regulated sector, a monopoly sector, you need, if you want to use the technologies, you have to introduce free market. And free market means leveling playing fields. Nobody has any privilege. Stable coins, deposits, money market fund, whatever is where you put the money, everybody do not have any privileges. And the other thing is the state has a role to provide public goods, for instance, money, not only physical money, also digital money. Now the state is providing digital money. I don't understand how people talk about the introduction of CBDC. No, CBDC exists. The central bank digital money exists. The question is the infrastructure can only be used by banks, another important privilege, probably the most important to end and to open the CBDC's access to everybody. And that would change dramatically the things and inclusive and competition of payment service providers and so on. That is the first. The second, all the privileges. And it's too long, Gérardine, but other interesting thing, if you want, is to change monetary policy. It's the most terrible intervention of the state. Are billions. For why? Why? To have and to manipulate a price, the interest rates. It's incredible, and we accept that. But it's the first lesson of the economic sector, of economic lecture. If you want, you increase or not the amount of money. And you see what is the result. The result will be the market decide, but not. And then, but it's too long that. I mean, sorry.
No, thank you very much. And certainly it isn't long in the richness of what you've said so far, really. It challenges at the baseline exactly how we conceive money and the systems that we're talking about. CBDCs existed for many, many decades. The question is the access, the knowledge of this. And I think this is a shift of perception that perhaps is something that we want to discuss as well. I'm going to hold that, and we're going to come back to Dr. Fernández, Ordóñez. But it'd be good to then hear, in terms of the future as well, what's happening now to build the future, what the Bank for International Settlements is doing. And before I actually give the floor then to my colleague on my far right, I'll invite the audience to maybe think about your reactions. And we're going to try and take a few. Help me here, because otherwise it would just be me speaking, and it's not a pretty sight. So help me here. Have a thought about what you'd like to ask or respond to any of our speakers, and we'll take your interventions immediately after. So I have given you notice. But in the meantime, perhaps like to ask Dr. Marino Folonvaida from the BIS, because of course BIS Innovation Hub is a famous thing. The projects like Nexus, Rosalind, which help shape that collaborative infrastructure. Now, keeping in mind what we just heard in terms of collaboration, knowledge access, how are projects like this, Marino, for the future of digital money? Please, you have the floor.
Thank you. And let me also express once again a big thank you to organizers. Thanks for having me. Thanks for organizing this amazing conference and also for the unforgettable night yesterday. That's really, really inspiring. So I was very pleased to hear that quite a few of BI's projects made it to this conference. The few were mentioned. And maybe I can break it down in two examples. So one way to approach this is that we focus on enhancing the current systems. And the other one is really enabling the new. A great example of this first approach of basically enhancing the existing or the current is Nexus. That was also mentioned yesterday. Nexus aims to improve cross-border payments by standardizing the way fast payment systems connect at scale. So instead of requiring a payment system operator to build custom connections for every new country it links to, the operator can establish a single link to the Nexus platform, basically bridging the different systems. This single connection then enables a fast payment system to seamlessly interact with all fast payment systems in the network. Of course, leveraging the existing means existing challenges, and I think that was mentioned yesterday quite vocally around, for example, the FX aspect, the crime aspect, that may remain and might not be addressed in those innovations. I can do some marketing here. I think Nexus was the first project of the BIS that is handed over to the central bank for implementation. So the first mover central banks have established an entity in Singapore to operate and manage then the Nexus scheme. And I think we're very happy about this fact. Then the second approach is really kind of foster development of entirely new financial architectures. And a very good and also very recent example is our most ambitious project so far. It's Project Agora. Project Agora is very, very ambitious. It aims to build a prototype for wholesale cross-border payments that incorporates tokenized commercial bank money with tokenized central bank money on a unified ledger with atomic settlement based on the correspondent banking model today. The project is a private-public collaboration with 7 central banks and more than 40 international financial institutions. So this sounds very complex, and it is. I just imagining applying Professor Kleiner's galaxy and also Professor Wong's table with the dispute resolution mechanism to such a platform. However, I think it's an interesting project. We have seen quite an increase of interest in projects with tokenized deposits. One project was mentioned, or I think a similar project was mentioned on the first day with the commercial bank money tokens in Germany. We have seen an uptake from, I think, 2002. We had yearly once a project around tokenized deposits. We had 8 we are aware of in 2023, and we had 9 in 2024. So I think there's a clear trend to this tokenized deposit. In our model, and I will not go into much of the details, but in our model, the tokenized deposits really try to leverage the existing practices and regulations applied to traditional deposits. And maybe we'll have a discussion there. But the tokenized deposits then can basically be positioned to address certain risks posed by stablecoins approaching systemically significant scale. In our model, the tokenized deposits are digital non-bearer instruments. They are transferred via burn issue model and are not directly transferable from one holder to another. is only be transferred to customers of the same deposit-taking institutions. Payments across individuals, therefore, do not alter the liabilities between the banks and their customers, but do not introduce credit exposure across the institutions. So basically, it changes the changes in the banks and institutions' liabilities are offset by making payments in central bank money. Therefore, any doubts about the exchange value are eliminated and the transfer takes place at par. This feature is key for maintaining singleness of money. I think I stop here and hand it back to you.
Thank you very much. And in particular, thank you as well for the introduction to Agora, which I think is a fascinating project. It bridges so much of what we think the potential of this digital currencies in general can be, both in terms of cross-border settlement, but also in terms of using it for more, let's say, philosophical underpinnings in terms of access, for example. I'm going to look and see whether we have any reactions, anyone who'd like to react to what they've heard so far. I've had the experience of having just been here yesterday and today, and things are still percolating given how diverse and rich the discussion has been. But if you have a first knee-jerk reaction even, it'd be good to hear from anyone. Yes, please. I don't know how we're going to manage. I just came up with this. I don't know how we're going to manage this, but can I maybe hand you, or can you come up if you wouldn't mind? And for the purposes, thank you. And for the purposes of the, for posterity, essentially, would you state your name and affiliation and then your reaction? Thank you.
Thank you very much, Carol. I just want to intervene here. It's a bit dreading on my side because I'm the only technologist in the room, probably with the exception of Dr. Goodall. We both work in the ISO standard committee, and my question is a bit technical but also philosophical to Marino. Why the financial sector is so reluctant to work with the international standard bodies? Because you create de facto standards that they are just after a long time become public official standards like SWIFT messages, for example. So my question is, you don't want to talk directly with techie people, or what is the rationale for this?
Well, I know Marino to be an extremely friendly person, so I'm sure it's not a matter of not wanting to, but please go ahead.
Yeah, no, I mean, I'm not sure I'm the best position to answer that question. I am not aware of kind of this, systemic reluctance to work with these kind of institutions. Agora, I think, is a good example where we have, for example, SWIFT, which I think is close to these kind of standards. We work, they are part of the project. So I think it is, embracing innovation brings that, I think, with it, that I think that at least we should be open to collaborate with them. So I cannot confirm that there is kind of a pushback to work with these organizations. At least that's my experience. I cannot comment any further on previous positions on that.
Thank you very much. We have another.
Yuri Biondi, CNRS France. I want to ask you if you can elaborate a bit more on the relationship between the Agora project and the foreign exchange risk, because it's very intriguing. Because you are talking about cross-border.
Yes, it's not covered in the project.
Oh, okay. Yeah.
This is really the prototype.
Okay.
Of course, the ambition would be to continue with the platform. FX was discussed, I think, in the first minute of the project, whether we should try to tackle it within the project at this stage. Mm-hmm. And I think the conclusion was quickly taken that this is too early days to really kind of, consider that in detail.
It's a very good way forward.
Yes, indeed.
If I may.
It is. But it is something that hopefully will come, of course. So we have the ambition to continue.
Sorry, again, I have another question more specific to BIS initiatives. I'm here because I was organizing a meeting about Finternet in Banco of Spain last year, and Rossa and Filippo were so kind to invite me here. I want to know what is going to be the future of this Finternet philosophy after Carsten is going to retirement, and now you have another general director.
Well, I haven't met him, and I don't know what the strategy will be. The Innovation Hub was very much, if I may say so, the baby of the existing general manager. So I think he was very much pushing. He resourced that massively, and it's really kind of part now of the mission and of the vision of the BIS, really, to kind of work in innovation, to foster innovation. Whether or not that will change, it's early days, I think, to comment on that one. But it's a Spanish person, so that makes him probably open to innovation, if I'm not misquoting here. So I think the hope will be that the efforts is continued. I mean, we have set up several, it's actually 7 hubs around the globe. They are here to stay, so I will not expect them to go away easily. But I mean, it's not my decision at the end of the day. But I think we're very positive, and I think it's well recognized as an essential, it's a crucial part of the mission of the BIS these days. Thank you so much for the question.
Thank you very much for the questions, and thank you, Marino, as well. We have another question, perhaps at the back of the room. And while the microphone travels, please, for posterity, just I think for the recording.
Should I go there?
Yes, so probably that's the camera that you're both speaking to. If you would introduce yourself and state your affiliation,
okay.
yeah.
Sorry.
There we go.
Well, maybe
we live in a media world, you know, so we actually do need to have all of this actually very rich debate recorded. Right. Please, if you would introduce yourself on the camera. Thank you.
Thank you very much. I want to this debate bearer, non-bearer instruments, because it goes back to the contribution by Brett and Hyun-Soo, they wrote a very excellent piece that which clearly defines what they mean by bearer instruments and non-bearer instruments. Right? When I compare stable coins such as USDT issued by Tether or USDC Circle, they are bearer instruments in the sense that whoever owns it, the issuer of the stable coin do not change at all. And deposit token. Oh yeah. So deposit tokens is a non-bearer instrument. But when it comes to stable coins issued by commercial banks, are they bearer instruments or non-bearer instruments? It's kind of puzzling in my mind that, JP Morgan coin, they provide a service for their customers in order to make the global cash management more efficient. But, those customers that they have accounts that, or they're issued by the JP Morgan anyway. So when it comes to coins held by non-customers of the JP Morgan, I wonder what's going to happen. Somebody else has to intervene, MUFG Bank, or has to issue their own a coin in order to substitute JP Morgan coin. So the mechanism under which it's the bank, in the case of banks issuing stable coins, is not clear in my mind. So I wonder if you have any,
No, thanks so much for the
sorry,
question.
Marino, you're always on the spot, but please.
No, it's a very good question. I think it really depends on the structure and on the model you use. So it was a big discussion also for Agora, how you should design the model. Should it be a non-bearer instrument? Should it be a bearer model? And I think you have that discussions. I think with the JPM coin, that's an on-us transaction. I think you can, within the JPM ecosystem, you can transfer it, but you can't transfer it outside without redeeming the token. Whereas here, it's clearly a non-bearer instrument model we're following. You can only transfer it, as we discussed also, within the customer line, like a traditional deposit. Stablecoin, on the other hand, they are at least mostly structured in a way that it's a bearer instrument. Whoever has the token in whatever form that comes has the rights on the tokens, let's put it that way. But I agree, I mean, there are different shades of grays in the different structures and in the different models. The message here clearly for Agora, the aim and the purpose is to structure it as a clear non-bearer instrument, that you cannot transfer it like this. You always burn and issue the token in that sense, if you want to call it like that. Although strictly speaking, it's not a token.
Thank you very much. Would please go ahead.
Mr. Can I very shortly add that allowing deposited tokens to be transferred as bearer instruments would be tantamount to restoration of free banking, in fact.
Yeah, absolutely. Absolutely. Sure.
Thank you. Thank you very much for this, and I think this question is not just for BIS actually, but also for ECB and many of the other institutions that are represented here. I want to follow up on Dr. Kobayakawa's response on this about bearer instruments, because it seems to me that we have this question that's right under the surface about how the owners of money actually store it, which is to say, some kind of something. And it sounds like a lot of the proposals have really been accounts. Let's just call them by what they are. They are accounts. And if we talk about accounts, as we know, we can't have accounts without accountability and that relationship. And it's very hard to imagine this being compatible with the idea of a bearer instrument, or indeed any kind of object that you can possess and control, which is to say, it's always subject to the whim of the account provider. So I think my question is, how are we going to support non-custodial ownership of these kinds of assets? And I think that it's important to retail consumers, of course, but it's also potentially important to sovereign governments who do not necessarily want to be held up by others in this context. So I think we really need to address this problem of how we're going to hold money outside of accounts. And I'm interested to hear your perspectives on this, and not just yours, but others as well. Thanks.
Thank you very much, and thank you for opening the question to the rest of the panel. Just to, I don't know if Marino wants, because he's been on the spot a lot. So does anybody else want to react to it? Panos, would you please go ahead?
Thank you. So the digital euro proposal defines the digital euro as a central bank liability. Following that, you have two variants, both of which are a central bank liability. One that utilizes the current PSP, well, banking system, if you want. They are also non-bank PSPs, but mostly credit institutions, in order to mirror the entitlement of the payment service users in the balance sheet of the bank. And then there is the offline variant, which basically doesn't need such an intermediary. This is the structure as foreseen by the regulation.
Can I just interrupt?
Sure.
This offline variant that is proposed by the digital euro depends essentially on a trusted execution environment, which is to say, a representation of the custodian's interest inside a device that happens to be carried by individuals. So let's call a spade a spade. A trusted execution environment with a trusted, Leviathan who creates these is just another kind of custodian.
I'm happy you see it this way, at least as per the proposal. In this particular case, you do not need a third-party intermediary to validate a given transaction. So, and whether, we need to or want to do away with the banking system, at least as per the drafters of the regulation, but also as per the designers of the digital euro, we do not. We do want to maintain the dual banking system, and we do want PSPs to play an active role in the distribution of the digital euro.
If I may.
Anyone else? Yes, please, go ahead.
So here, you're really going into the actual difference between a wallet and an account. The problem is that many people say, oh, it's a wallet, it's fine. it's not an account, right? For me, the way I define a bearer instrument is like, if you think about cash, physical cash as bearer instrument, it means that you can transfer cash from one person to the next without the need of a third party. For me, this is the definition of the bearer instrument. And the consequence of that for banks is indeed that it stays the same liability of the bank. So what was discussed here is the consequence of how you transfer that particular instrument. When it comes to the wallet themselves, I mean, that would require a structure like a distributed ledger technology for it to be transferred without that central entity. Now, the problem that you see is that when the financial sector adopts those technologies, typically what it will do is that it will try to use that technology, but make it centralized. And therefore, the whole idea of having a pure bearer instrument itself doesn't really work in that context, at least from what I can see.
And
Thank
maybe
you,
just
Marie.
add as a last comment, I fully agree with many of your points. I think it's an interesting discussion. There will be more, I believe, from the BIS on that topic. So I think it's really at the core of one of our, how should I say, key reasonings around the structure of these models. I think there will be more from us in more detail on how we see these things.
Thank you very much. I'm just going to check in with...
That doesn't answer your question today.
You will get an answer probably sometime in the future, but perhaps not today. But thank you for the question, really. But before we leave that question, I'm just going to check with Dr. Fabio Araújo online, just to see if he has anything he'd want to add to that discussion. You have the floor. I'm afraid you're muted. No, we are muted.
Can you hear me now? No.
Perfectly. Please go ahead.
Yeah, okay. Yeah, I would just want to add a specific point regarding the technology of trusted execution environments. This technology is being used today for non-custodial hardware wallets already. Then it's not necessarily a way of intervention if you use that technology. You can use that technology in a less intrusive way, and that's related to what all other colleagues mentioned prior. It's more up to the regulatory framework than to the technology itself. Thanks.
Thank you very much. That's actually a very nice segue, perhaps to the topic on sovereignty and financial stability, because of course, if we undo everything and we have a system that we want to move towards in the future, the question basically is how to maintain that stability of the financial system. Do we want to do that? Assuming the answer is yes, but let's see. But let's have a think about this. It's a good question actually about bearer bonds and what does it mean also in terms of wallets versus accounts. But when we're talking about digital ledger distributed ledger technology, it's something that we're facing in my organization, which I might speak about a little later on. Is it truly distributed? Do you actually still have someone centralized watching the system? I think that's something that, in the end, is it simply a different application of exactly the same philosophy? But I think the tension still here is between central bank issued money, digital or otherwise, and private digital money. And if private digital money becomes widespread then through stablecoins, digital deposit tokens, tech platforms, then the question is, does it threaten, should it threaten, will it threaten monetary sovereignty, policy effectiveness? How will central banks respond, and then how will the users also respond? I think that's probably the underpinning of your very good question. So maybe that's something to perhaps move towards. I do have maybe some more directed questions, but if any of the panelists would like to also maybe discuss about this from the European Central Bank, of course, and from the Croatian National Bank as well. Can central banks really defend monetary sovereignty as these private tokens and platforms expand? I don't know, Dr. Svelčak, perhaps. Sandra, would you have some thoughts on that?
Well, I think that here we can talk a lot, and we are experts in our field. We can understand each other, but out there are people who have no understanding of what we are talking. They only want to have trusted means of payments and to have the means to store, which store their values, their wealth. And I think for them, you know, if this singleness of money is eroded, the only one that will be responsible for that would be central banks, and they don't have all the they don't have the control over all the money that is around. I think that it is very confusing and puzzling that all these private monies have the names that disguise the real nature of those monies. So if something is called cryptocurrency, is considered as currency, as money, something that is solid, that is regulated, people don't understand what it is. If something is called stable coin, it's very ironical, it's cynical to be called stable and coin, something stable and something cash-like that is backed by the authority of the central bank, whereas the central banks don't have the means to control that kind of money at all. So I think that it puts us in a very difficult position because people out there have not studied economics, finance, nothing like that. I have tried to talk to my mother about the digital euro, and you know, digital euro is the currency that will be issued by the central bank. It will be public digital money. However, for her, it is all the same. It's just a big fog. You know, and it will stay up to the central banks to control the financial stability, the stability of money, you know, the stability of prices and everything. So it's too much burden put on someone who does not have the instruments to control, you know. And I think that we should have in mind that the other people, the businesses, the citizens don't have the understanding of everything as we do. And they will be the users of it, whatever that is. So I think that it is the responsibility of central bank to provide retail CBDC, to exploit, you know, the benefits of the digital transition, to offer the public means of payment for online payments, for example, which are completely impossible to be executed without any form of digital money. It's up to the central banks to provide wholesale CBDC in order to give the possibility for fast cross-border payments, to promote instant payments. So it's up to us to offer this very solid infrastructure and very solid alternatives to private digital monies. And I think it's also up to us to first to communicate well. What is money? What is legal tender? Why are deposits or banknotes legal tender, and private digital money is not a legal tender? And it's up to us to try to convince the legislator to put in place the appropriate regulations.
Thank you very much. I wondered if Panos to your left has something to add on the European system.
Thank you. Much has been said already, with all of which I agree. We cannot ignore the expansion of private tokens and platforms. And I think there are two things, compete and preserve. The compete has already been mentioned. We need to offer the best possible product and user experience to payment service users, be it in the retail digital euro or through the facilitation of instant payments via tips. And the other thing is to offer the PSPs themselves the possibility to innovate and develop value-added services. Because remember, there is mandatory acceptance of the digital euro. So they are stuck with it anyhow. It's better for all parties involved if the experience is positive. Of course, when I say competition, I mean it in the economic broadest sense, not in the legal sense, because legally speaking, the euro system issuing the digital euro will not be an undertaking for the purposes of 101, 102 of the treaty, because we are doing it in furtherance, in pursuance of a sovereign task. And now the preserve. The preserve relates to ring fencing the access to the RTGS and to wholesale central bank money to the actors that we believe are best equipped to have it. And concretely on that, as per the 9th of April 2025, the Central Bank Governing Council has decided not to offer safeguarding accounts for the purposes and in the sense of MiCA to crypto asset service providers at all, and to non-bank PSPs, by the way.
Thank you very much, Panos and Sandra, for those insights. Anyone else would like to react from the floor on this? Please, I'm going to ask Dr. Ferry if she'll just walk over again. Thank you so much. Yuri, you have the floor.
Yeah, just a remark, though. Have you considered that if you exclude, okay, crypto asset operators are excluded, but if you start issuing the digital euro and non-bank providers or which operate through are not access to the central bank facilities, they could be systematically important payment providers which don't access. So have you considered this kind of scenario when you decide to exclude, or do you assume that only banks will manage the digital euro and so non-banks provider or digital operator willing to provide service through the digital euro will depend on the bank system? This is my, it seems very technical, but I think it's a very important problem for financial stability in particular.
Panos?
Thank you. Perhaps I haven't been clear. The exclusion relates to safeguarding accounts. They are not fully excluded from the RTGS. Credit institutions already have access because they're monetary policy counterparties, and non-bank PSPs will receive access for the purpose of conducting payments, but not safeguarding of clients' funds. And yes, under the proposal of the digital euro as it stands, credit institutions are obliged to offer free basic services upon request of their clients, whereas for non-bank PSPs, it is non-mandatory, it is discretionary. The central bank, in its opinion, because we are consistent, wanted a level playing field and wanted it to be mandatory for all.
Thanks very much, Panos, for that. Maybe just to provide a comparison with the European experience, we do have Dr. Fabio Araújo online, and maybe in relation to DREX, could you help us here? How does DREX interact with private digital money, and does DREX preserve monetary transmission if you have a hybrid monetary system? What's your experience there, and what are your considerations in Brazil as you move towards DREX?
Great. I think that one important aspect here is very much related to all that we've been discussing right now up to now, and the challenges is not just preserving monetary transmission mechanisms, but preserving them while allowing for the evolution of the system. That's the real challenge and the real balance that the central banks needs to try to strike. And for that, we need to have some strategies. We have the strategy of promoting participation in the market. And for DREX specifically, we talk to the entire market, the incumbents, innovators, crypto native companies, to make sure that we were able to provide or to propose a platform that is useful for all the parties in the market. Then for the incumbents, we need to make sure that they are allowed to deal with the digital space, with digital central bank money or other sorts of digital assets, tokenized assets. And for the the innovators that today are outside of the regulatory perimeter, we need to provide a regulatory framework, a regulated space that attracts them to this space. That's what we strive for. And for doing that, we've created this platform, the DRAX that we are testing right now, and specifically the division between wholesale and retail. When you combine that with the possibility of having tokenized deposits, tokenized e-money, and even regulated stable coins, you open up the market for the participation of newcomers and innovators. Meanwhile, you keep the possibility for banks to participate, and the central bank money is the basic source of outside money for the system. Then we keep the same paradigm of monetary policy as we have today. But this system has flexibility enough that we can move on to another sort of provision of liquidity if the market deems necessary. You can think, okay, this bank intermediation is not good enough for the digital asset space, then maybe tokenized money is better, and it's much more accessible because non-bank PSPs participate in that too, and even regulated stable coins could work in that same space, opening up even further for the participation of innovators.
Thank you very much for that insight. Does anyone want to react while I maybe look to my panelists as well and see? I'm seeing a tension between perhaps two, I wouldn't say pillars, but two structures that we have here. Really inclusion in terms of communications, people understanding what's happening, financial inclusion, access to capital and finance, and then this need for sovereignty, this need to control interest rates and markets, and it's a very regulated space. It's an extremely regulated space. So between the two, between Scilla and Charybdis, do we have a nice path to maybe sail? I wonder if maybe Dr. Rossi, would you like to take this?
Thank you very much. When it comes to inclusion and sovereign erosion, I see those two things as being complementary, in fact. If you think of the ultimate financial inclusion instrument for people who are unbanked, currently this is cash. And if you look at originally when central bank started to work on CBDC, really the idea was, what do we do with the dwindling amount of cash? However, as it is recognized that cash is that instrument used by the less fortunate, typically, we have gone from a cashless strategy to a less cash strategy. So instead of wanting to remove all of the cash, the idea is to have a CBDC as a complementary instrument to banknotes and coins. And therefore, this way, I think we can balance both the need of financial inclusion from the most unfortunate people in society, while still managing to avoid the sovereign erosion that will come from cash being taken away from the public. Thank you.
Thank you very much. And I really have to turn then to Dr. Fernández, Ordóñez here, maybe, please.
One minute. Thinking in the future, everybody could access to the digital money, like cash, and there is no protection in any private initiative. In that situation, I think that we should not be too worried with sovereignty, because the attractive of a safe money without risk is tremendous. I mean, then now, for instance, why now you have monetary funds? Why they are not used as money? Why? Because people want to have the idea that you have a unit account and something, and then if you are a government, you have to present the budget, and you cannot present the budget with, stable coins, cows, houses, because in principle you could use whatever asset to have a transaction, but it's normal that you want to have money, you change your asset in money, but you give me, and I present the budget. And I do not pay the civil servants, but it's not because I am powerful, because the enterprises do the same, and people do the same. You could tell me, I pay you with a monetary market fund, please send the monetary fund. Then in this future, you have totally separated the money that is no risk, is safe, it doesn't change face value, and it depends from other important thing that is monetary policy, but it do not change the face value. And the rest, you have the risk, and you could have the risk with very initiatives, Bitcoin, stable coins, that is it's like a bank. It's a bank without protections. It's the same. You put your money without protections, by the way, because one of the protections of the banks is that you could say that you have euros or dollars, and the stable coins cannot say you have dollars. No, you are forced to say that is Tether or this whatever, then it's one of the protections we don't realize, but it's important. No, we accept that the bank says that they provide dollars. They are not dollars. Then that's why you divide the unbundling totally the system of money and payments, unless people decide if you want to be paid with a share of Apple. Okay, but normally, if I want money, and then that's why I don't think we need to force people to decide and to use that. I mean, it's something that I am very optimistic. I mean, the money from the beginning of the century has been something very, very attractive for people. And then that's why I don't think we have to force people to use this money, allow them. Have the possibility, because the rest have risk. Of course, see, some of the private initiatives have the protection of the state, people would like to have the protection of the state, of the banks, and if I remember, if you allow me, the executive order of Trump with the CBDC is fantastic, because it says more or less that they prohibit, he wants that the Federal Reserve could not issue digital money. It has been very interesting articles of lawyers in the state. One of them, Lipsy, that was deputy governor in the IMF, saying, please be cautious, because you prohibit the Federal Reserve to issue CBDC, the banks are going to collapse because they need that digital money that is there. Then to be more precise and say that you say to the Federal Bank not to build an infrastructure to use the CBDC, but not prohibit the CBDC, because central bank digital money, we call reserve, but it's central bank digital money. Then, and the executive order of Biden that was in 2022, when Sala and others were in the Treasury, was interesting because they said that as stable coins, I think was a mistake, total mistake. As stable coins could be fragile and so on, we should think in protecting stable coins. That is completely full. I mean, you have to level the private initiatives taking the protection, not leveling, providing protections of the state. The state should not protect and should not sue. Nothing to, when I say nothing prudential regulation, Basel III. Why do you tell to the private initiative how they should take risk? You don't say to the hedge fund, you don't tell to any, why? Why? Because the only digital money that we have is deposit, and it's right. I mean, I want to say is that it's different what we should do from the decision the central bankers and so on do now. Because now they have the monopoly, they have the problems, and they have to decide. When I take the crisis and helped my government in 2008, I told the government to take 70,000 million euros to bail out the Spanish banks. And I would do again. But if we don't have the protection and the need of protection, you don't need to put any penny to the banks. Then it's different. That's why I want to transmit what I am thinking is in the future. I would never recommend now to say that. But I think that if we are in that future, we don't need this discussion of sovereignty because, I mean, it's not sovereignty. It's that people want to have a safe asset.
Thank you very much, Dr. Fernández. Ordóñez, we have a question down the front, or maybe a reaction, perhaps. Please go ahead.
Hi there, Christos Hadjimanuel. I have a small reservation about what you've just said. I'm very sympathetic to your arguments. Does this work? Doesn't work. I don't. Okay, I have a small reservation. But does it work? Now it works. Okay, I have a small reservation on what you've said. You emphasize the difference between official currency, fiat, and cryptocurrencies or stable coins by pointing to the difference in terms of risk. But the fact of the matter is that the bulk of monetary claims nowadays do carry risk because they are bank deposits, they are scriptural money, the majority of which is not covered by deposit insurance. So as I see it, you are right, but not for the reason that the one carries risk, the other doesn't. You are right for the following reason. We have seen that, that Bitcoin and other forms of original cryptocurrency did not take off because it does not have a stable reference to the price mechanism. The price mechanism is in an official currency. The Bitcoin fluctuates. Any other type of crypto fluctuates. So the real threat is stable coins. You mentioned mutual market, money market mutual funds and how they could provide an alternative to money. Indeed, if you had a fully guaranteed system which equilibrates, it does not break the dollar, then yes, it is feasible to have a demonetization and a mass shift towards money market mutual funds for wholesale transactions, at least. So my personal fear is the following. Imagine, and this is why I believe that there is a threat to sovereignty. Imagine a system where you have something like the Chinese arrangement, where you have automatic waterfalls of bank money into the wallets, okay? And then they are used as electronic money. But imagine a slight modification of that. So you have an automatic waterfall whereby the wallet completely retains a certain value, say, of 5,000 euro, correct? And this is done automatically. It is done in central bank money, in fiat rather, but this is scriptural money. And the moment that it falls into the wallet, let's call it Apple Pay, it is automatically converted into Apple's stablecoin, which is then being used in order to make payments, which is one-to-one to the dollar, one-to-one to the euro because of the contractual terms of the deal. And the money is then invested by them, they make good money, but because of the ubiquity of the system, it retains most of the payment accounts itself. So you have a silo with other services and these temporarily converted monies, and all the profits accrue to Apple. All the money which is used for payment accounts is retained provisionally, but retained in very large sums in the Apple stablecoin. And if they want to switch you off and cut you loose, because the American government, for instance, cuts you loose, suddenly you have a total collapse of the system. And again, the question that I asked yesterday, what do you do when all the money eventually becomes scriptural or inside money? How do you control monetary, how do you do monetary policy? But that's a separate question. It's not a sovereignty question, it's a technical question. So, Mr. Papapaschalis, if I can conclude, maybe the way forward would be exactly what the chair says, that you don't, or not, I'm sorry, the gentleman said that you don't recognize them legally as money, you give them freedom, but then you don't recognize them also as assets other than contractual assets, and you do not accept them for tax payments. You don't consider them an alternative currency, just a contractual relationship. This would kill them. And this is exactly what the Stable Act in the United States tries to avoid. It tries to legitimize them also for official purposes, and this is far too dangerous.
Thank you. I don't know if Panos or Miguel would like to react. Panos? No? Anyone else? I'm not seeing any first reactions in the room yet, but thank you very much. I've just been notified that we've just been joined by another of our panelists from the International Monetary Fund. We have Dr. Marcello Miccoli. So welcome, thank you for joining us, despite your busy schedule and having to move around with the schedule and come in for us. Now, we were just discussing, actually, the matter of sovereignty and financial stability. I don't know exactly when you came on. You might have heard the last intervention as well. But, you know, I don't want to put you on the spot. I'm just maybe holding that, and we'll probably come back to that discussion because I'm not seeing first reactions in the room. But perhaps I'll just give Dr. Miccoli the floor for a little, if he just introduce himself, and maybe just give us first quick reaction in relation to the IMF's role, and what role the IMF plays in the framework for regulating things like stable coins, so CBDCs, digital tokens, in a cross-border world, keeping in mind the tension that I think now there's more than one tension, so that there is the matter of sovereignty, versus other issues. There's also the matter of trust versus trustless systems. But without putting Dr. Miccoli on the spot because he just joined us, you have the floor. Thank you for joining us.
Thank you. Can you hear me?
Loud and clear, please go on.
Perfect. Thank you. Good morning to everybody. Apologies for not being able to be there with everybody there, but unfortunately, both family and work constraints prevented me from traveling. Thank you for, you're putting me on the spot. I just joined this early in the morning. I'll try to do my best. Now, I don't have actually the video. I only see myself. I don't have feedback from the room. So if it's possible to have feedback to the room, would be actually helpful also for me in order to interact more meaningfully. I'm saying this to the technical people. In any case, no. What is the fund? What role is the fund playing among this? So, I mean, I just wanted to broaden it a little bit before we start. And the role of the fund, the mandate of the fund, is really to preserve the stability of the international monetary system. Now, both stable coins, crypto asset, and CBDC, those are very different objects, but I mean, they both could have implication for the stability of the international monetary system. We know about crypto being possibly something that is used for some form of cross-border payments. We know about CBDC, that is open cross-border, could actually endanger monetary sovereignty and lead to currency substitution. So these are risks that for the international monetary system, and the fund needs to be there, needs to monitor these risks and needs to understand what are the implications. So what has the fund been doing and in this world? We've been really trying to, understand risk for the international monetary system, promote design choices that can mitigate risk, and also promote regulation principles that can hopefully mitigate risk. So we are working together with other international financial institutions, with the BIS, with the FSB, with FATF, with the World Bank, with standard setting bodies like CPMI, IOSCO, and with many other central banks. Some of these are actually here in the room. We have a discussion with Fabio before. Good morning, Fabio. It's a pleasure to see you again. The IMF brings this comparative advantage of macro financial expertise and global membership. We are not regulators per se. So what are we doing? We are doing policy advice, we are doing capacity development, and we are doing surveillance. Those are the key activities of the fund. In terms of stablecoins, crypto, well, we have developed the elements for an effective policy framework for crypto assets to help countries build their own framework. So in this framework, we have defined 3 main areas where countries need to look at. One area is macro financial consideration. There is actually the problem of monetary sovereignty, how to make sure the monetary sovereignty is stable. And usually the problem with monetary sovereignty, I don't know what was the question made before, but in general, if we have fears of currency substitutions, those are usually coming also from the fact that currency have weaker macroeconomic fundamentals, so more volatile exchange rates, weaker monetary policy framework. So in general, the recommendation there is always to safeguard monetary sovereignty by strengthening monetary policy framework. That's the first line of defense against everything. But then within this framework, we also talk about guarding excess capital flow volatility. So making sure that what our capital flows management measures also work in the crypto world. And there are different ways in which we can think they can make it work. But also to develop and enforce prudential conduct and oversight requirements on all crypto markets actors. Now, we are, closely collaborating with standard-setting bodies to develop this and implement this comprehensive, globally consistent and coordinated policy and regulatory framework. We are doing capacity development with countries in order to help them design the regulatory framework, upskilling human capital, and strengthening central bank capacity. Some of these, for many central banks in the world, are new topics. They don't have the skills, the human capacity at the central bank in order to tackle these topics. We're also doing surveillance, and we're trying to integrate these crypto asset topics within our Article 4 assessment, which is one of the key topics of the fund, and the financial sector assessment program, which is actually one of the key products of the department where I come from. I come from the monetary capital market departments, and we are responsible for doing the financial sector assessment program to countries. We are developing a common framework to addressing data gaps. There's something also very important in terms of this new world. We don't know enough about what are the flows, what are the economic forces underlying. And this is because it is mostly, there are no data reporting flows. We know sometimes blockchain are fully open in terms of we can see all the transactions, but then we cannot actually determine flows between one country and the other. For CBDC, also, we are doing a lot. We are supporting countries, and the same also for tokenization, something that we are looking, so the representation of assets on the blockchain, something on which we are working a lot. Now, I don't want to be too long now. Probably there will be questions, so I'm going to be able to go more into the detail into some of these aspects. But just in general, what are some of our guiding principles whenever we look into this? The first thing, given the role of the fund, is really we want to preserve macro financial stability and monetary sovereignty. That's what we are there for, because we want to ensure a stable international monetary system. But then a stable international monetary system also is there if we avoid fragmentation. And it's also something that we're very keen on. So we don't want countries to be left behind, to be somehow not involved in the process, but also we don't want to create silos. We don't want to create a crypto payments or this new technology create blocks of countries that only communicate with each other. And finally, we want to foster collaboration among all countries. The role of the fund is also the one that makes sure that all voices of all countries are heard at the table, especially, for instance, at the table where rules are drawn. And so we want all countries to be present there and have their voices. And I'm going to end it here and open for reaction. Thank you.
Thank you very much. And thank you for joining us and for that nice overview, actually, of what the IMF is doing. I'm going to see if there's any reactions in the room yet. But I think it's actually a very interesting way to perhaps start a discussion on regulation and interoperability and the legal frameworks that wrap around these sort of systems. So we talked about private digital money. We're talking about central bank digital currencies. We've heard we don't want to have, it's a no jurisdiction left behind type approach. having inclusion. But then the question, of course, of how autonomous should each end user be? Can we expect them to understand all of this in the fog of the information? I remember when I first came to this field and I was absolutely terrified at the amount of information that kept coming. I spent days and days reading and some more stuff kept coming and I was never up to date because whatever I read today was out of date tomorrow, essentially. And it's frustrating for a group of people who focus on this. So if we have consumers who use as end users and want to perhaps not, give them the autonomy to choose, but then also protect them in a trustful system, let's say, or do we go directly trustless? How does that work? How does the global financial stability of the markets work? Is that important? Do we want to dismantle everything? Is it something, of course, for the future to think of, something that in the present? But perhaps that maybe goes into something a bit more concrete. I'm going to look all the way to the left and to Panos. We, of course, have discussed it several times this week, the European Union's MiCA regulations. And perhaps it would be just good to just start there in terms of a more concrete discussion on the addressing of the financial stability in a future that is tokenized, not just digitized, not just digital or digitized, but actually tokenized. So maybe Panos, you'll take us there.
Thank you. I recently learned that this issue spurred controversy because our president's comments were, negatively seen by the Commission on MiCA, on the need to act. I'll try to be as objective as I can on this one. Is MiCA enough currently? To begin with, we're only talking about stable coins, and we're not talking about EU CBDCs because they're excluded from MiCA, and we are probably also not talking about third country CBDCs that have signed the agreement with the ECB under Article 21 of the proposal, because those probably are conformant to whatever standards the EU would actually expect of them. So we are speaking about all the rest, be it stable coins or other third country CBDCs. It's important to note that any conclusion we now make on MiCA is tentative, because as Professor Hadjimanuil stated yesterday, the full text only entered into force something like half a year ago. And also, currently we have a very small number of EMT and ART issuers active in the EU market, and very few I hear from colleagues in the SEA's authorizations coming. Now, yesterday, Professor Hadjimanuil aptly explained why the listings indicate preliminarily that MiCA has teeth and has been enough as it stood. I note, however, that when MiCA was adopted, there was a recital 4 in the original Commission proposal, that stated markets in crypto assets are still modest in size and do not present a threat to financial stability. And that at the time, so 2022, 2024, held true. The recital continues. It is possible that types of crypto assets that aim to stabilize their price in relation to a specific asset or basket of assets could in the future be widely adopted by retail holders, and such a development could raise additional challenges in terms of financial stability, smooth operation of payment systems, monetary policy transmission, or monetary sovereignty. All notions which, my fellow speakers explained thoroughly. This to me reads like a rebus extendibus clause in the regulation. In the current geopolitical conundrum, where you have a major jurisdiction that actively promotes stable coins and disposes of the liquid and deep market in order to back them and to promote them and push them everywhere around the globe to the detriment of CBDCs, I don't think it is untenable that we need greater focus on financial stability of the euro. Now, how can this be achieved? Should the Commission act? For everyone that is familiar with EU law, this is something completely up to the Commission to decide, because they dispose legislative initiative. We can tell them, please act. The Parliament can tell them, please act. But, if they do not want, the worst they need to do is to explain why not. Accountability. So one could indeed amend MiCA to strengthen the references to financial stability, which are already there. we're speaking about a strong risk to financial stability in both the cases of authorization of ARTs, EMTs, and in the cases of publication of sanctions. So it is something already under MiCA's radar. Another way of doing it could be through supervisory regulatory praxis. So because these financial stability considerations are embedded in the MiCA provisions, the weight of financial stability risk would need to be assessed pragmatically, that is in the given state of affairs, in the sense of, who is backing the crypto assets, what exactly is the potential in my jurisdiction, how do consumers react, how much does it actually target them, how easy would be to conflate it with sovereign money, and so on and so forth. I think these are the elements I would want to add.
Thanks so much, Panos. I'm going to see if there are any reactions from the Eurozone jurisdictions or from the IMF on this matter. So I think we're happy with Mica at the moment. So let's leave it there for the moment then, perhaps. But then maybe turn to Marino at the BIS then, in terms of coordination. So the Eurozone, of course, is highly coordinated and has its own structures for that. Globally, we have nothing like that. So do you think there is a need for global coordination in this particular aspect, something like a BIS 2.0 for tokenized systems maybe, or 4.0? Marino.
Well, I mean, BIS 2.0 sounds very innovative, at least, so I think. Look, and maybe just to complement what Marcello said on the IF, maybe from a BIS perspective, I think the primary mission of the BIS is to foster monetary and financial stability through cooperation. We serve as a forum for discussion and as a platform for cooperation. As we discussed before, innovation is part of the BIS mandate. It's identifying key tech trends. We're developing public good digital tools. And we're networking experts in the central bank community to basically navigate tokenization. We do a lot of research and analysis, maybe not enough in certain aspects, but we will do on the aspect of the non-bearer instrument we just discussed. And of course, we have existing committees, as Marcello also mentioned. The FSB paper was mentioned previously. Just to clarify, the FSB is not part of the BIS, but it's a hosted association of the BIS. But I'm more than happy to kind of to come back with some feedback on some of the views expressed in particular in the keynote speech on the first day. Potentially the standards being a bit defensive on certain developments. I think the buzzword here is the gateway stablecoins. Yeah. There's a constant discussion, and of course, also Marcello just mentioned the committees of the BIS. We have the CPMI. They have delivered a report on tokenization, impact on money and finance. The BCBS has issued prudential standards for banks' exposure to crypto assets. The Committee on Global Finance Systems and other BIS groups monitor evolving market risks and the liquidity conditions, which increasingly, of course, then also include developments, crypto assets. So in that sense, and overall, I think the BIS fulfills a lot of these, or plays a role in that coordination. We see a lot of discussion also among the central bank communities through the projects we are mandating. A key aspect, and that was voiced yesterday also very prominently, is kind of the private law aspect, which is kind of a little bit detached from that discussion, as I think that's an interesting aspect, and that's something I am happy to kind of report back with. Overall, I don't see a need for a BIS 2.0. Although it's a nice idea. But I think the message here is that a lot of this coordination work, to the extent and within the mandate of the BIS, with support, of course, with other international organizations, and particularly also the IMF, I think there's a lot of work being done, and I think we will continue to play that role, maybe even expand it where needed.
Fantastic. Sandra, please, go ahead.
I would like to pose a question to Mr. Miccoli from the IMF, if you hear me. So you perhaps have a better overview of the global monetary system. So I would like to ask you whether you can see the major transformation of the global monetary system and transition from the system in which dollar was a reserve currency to a bipolar monetary system. And do you think that we have currently in place the weaponization of money with US dollar-backed stablecoins? Thank you.
Dr. Miccoli?
Thank you. Thank you for this very interesting question. So in general, I mean, there are two parts of this question. Generally, one question is, are we seeing material changes into the international monetary system given the emergence of new technologies? So far, there have been changes, but these changes are not posing material risks or changing. We know that, there's been an adoption of crypto. We know there's been an adoption of stable coins. But in terms of what we would like to see to have material changes, we would like to, large interconnections with established financial systems, large amount of use by the population. So we're seeing use, but in general, from what we can understand, there are not yet, the use is not so large that there are material risk or changes. Now, in terms of stable coins denominated in dollars, well, the US dollar is already the dominant currency, and this been for the monetary system, and it's been so for the last the post-World War years. The fact that there is a stable coin denominated in USD clearly will reinforce, could also not just reinforce the role of the dollar, and also possibly increase the demand for US bonds, US treasuries, because, the stable coins, most of the times, they are actually backed by US treasuries. Right now, the scale of the phenomenon is not as large as something that we think is going to have material impact in terms of anything else that we're seeing in the world. But clearly, we are looking carefully about these things. Will it become, is money being weaponized? Well, I don't know really about that. I mean, money has been, money is used for many convenient things. The fact that you want to impose your money onto somebody else's countries, well, it really depends whether other people want to accept it. People at the end, they go for their own convenience when they make the choices. And sometimes we know that, there are geopolitical and institutional considerations why the dollar, trade consideration why the dollar is very widely used with respect to other countries. We don't know whether in the future, the fact that whether there will be, possibly new technology or maybe even other currencies, other stable coins emerging different currencies will change the international monetary system. For sure, what we know from the past is that if there are changes, these are not very fast. But we know we'll never be going to be sure because the technology now allows for much faster for much faster changes. I mean, we've all seen with the recent banking crisis in the last years, that this technology allowed for a much faster run to the banks with respect to previous years. So that's something that we had not seen before. But we are monitoring, and we'll see. We are very careful to understand what is the change and what are the implications of this. But so for now, I mean, I would say that there's not been any big change into international monetary system. Thank you.
Thank you so much. Let's stay online and see if Dr. Fabio Araújo would like to give us an opinion from the Brazilian perspective in terms of emerging market, large markets actually, central banks approaching innovation as such. Maybe Dr. Araújo, would you like to perhaps come in on this?
Give the Brazilian experience. I can mention the Brazilian experience. And I would like to stress two dimensions. In the first dimension, I think that to tackle innovation while avoiding systemic vulnerabilities, the regulatory strategy is fundamental. The Central Bank of Brazil is being deemed as an innovator regulator, and that sometimes sounds funny because our mandate is for stability. But in a world where technological innovation and the absorption of innovation and technologies into financial markets is every time faster and faster, we need to try to find a way to incorporate those technologies in a orderly manner. Then we have this tension between the short term and the long term. In the short term, regulation is here to promote stability in general, financial stability, monetary stability. But in the long term, we know that the technologies and the innovations are going to be incorporated into the financial sector. We know that for sure. We cannot turn our backs to that reality. Then we need to figure what should we do, what should we've been proposing to the society in the medium term. And that's where the regulatory strategy focused on innovation enters. We need to always be analyzing the market, analyzing the innovations that are happening, and try to figure out ways to better introduce this in such a way that in the short term we do not cause such a hard disruption, but in the long run we allow the system to have flexibility enough to move on forward. In the second dimension that I would like to mention for tackling this problem is the market participation. Central banks, as regulators, we cannot create the infrastructure all by ourselves. We need to understand what are the market needs, what are the societal needs, and to try to incorporate that in the evolutions of the regulatory and the systems that the central bank provide for the population and the market. And one very important instrument for us in Brazil for doing that are a series of innovation labs. We have an ecosystem of innovation labs where we have regular engagement with market participants, incumbents or newcomers, and we are always trying to learn the feasibility and how usable these innovations are. And then when we deem that it is has a positive value for the society, we try to accommodate the regulatory framework so we can incorporate these new strategies, this innovation, these new business models. Then I think that regulation and listening to the market are the main aspects for dealing with innovation while avoiding systemic vulnerabilities. Thank you.
Thank you so much for that. Maybe then coming back into the room and talking about regulation, interoperability, and the evolution of our structures and our ideas over time. I'm just going to turn to my right here and ask Dr. Rossi if he has ideas and thoughts on the redefinition or harmonization of these sort of structures for our digital economy.
Okay.
Dr. Rossi.
So if we look at one of the things that has been most talked about is the concept of legal tender. The problem with legal tender is it's one of the things that talks to no one and yet is not the same thing for anyone. I'll give you an example. The LTEG, which is the European Legal Tender Expert Group, back in 2009 came up with a report that basically said there is no common features between the definitions of legal tender in the EU. So I let you imagine worldwide. As a result, we had to wait until 2021 in the EU for the ECJ to come with a court case that basically said there are three different elements of legal tender. The first is mandatory acceptance at full face value. And finally, that gives you the power to discharge your obligations. After that, the European Commission, within the context of the digital euro, took this opportunity to propose to codify those three attributes of legal tender. And why might it be an important time now to want to bring some clarity as to this concept internationally? If you think about it, the concept of legal tender used to apply to a very small subset of the monetary system. It will only apply to banknotes and coins in most countries. And therefore, really, you have to ask yourself, is a legal effort on that scale needed for a concept of money that is becoming less and less relevant for modern society? However, I would posit that with a couple of central bank digital currencies out there having been proposed as legal tender, the concept itself of legal tender has found a new relevance. And therefore, in the context of promoting international cooperation, I think now is the time indeed to bring clarity globally as to those concepts. Thank you.
Thanks very much. Sandra, would you like the floor?
I will try, but I'm not a legal expert, so maybe I should refrain. So, in my opinion, not only coins and banknotes can be considered as a legal tender, but also the side bank deposits should be considered as a legal tender, because through money transfer they offer this finality of settlement of the obligations, and are mutually accepted. And there are very powerful instruments that give the side deposits the status of the legal tender. And that is, first of all, deposit insurance schemes, then banking supervision, convertibility, constant convertibility to coins and banknotes, and the possibility to access the liquidity from the central banks. So there is a very solid backing for deposits which give them the status of the legal tender. Maybe not in legal terms, I'm an economist, but that's how I see it. So, correct me.
Thank you very much, Panos.
I wouldn't dare. No, I wanted to have a very brief reaction to something that Dr. Rossi mentioned, because I was in the room when LTEC 1 took place. The member states delegates did find that some of the elements of legal tender, that is full face value and extinction of monetary debts, were, and I think it is in the report, siren notions. The problem was in mandatory acceptance, and the problem was, and now I refer to the schema by Professor de las Heras Valel of yesterday, the problem was in the private law, in the sense that it was deeply intertwined with what exactly is a payment obligation, a monetary obligation. In some countries you did have administrative fines, in some others you might even have criminal law protecting banknotes and coins, and for that, EU member state being notoriously reluctant to harmonize civil and criminal law, it was left as a recommendation. That was the reason why we had to wait until Hessische Rundfunk for a bit more clarity.
Thank you for that insight. It's actually really interesting. Perhaps just something to add. We had at the Hague Conference on Private International Law a discussion about whether we should go towards normative guidance for payment systems. And as part of that discussion, the question of whether legal tender, whatever legal tender meant throughout the world among our members, should be part of the discussion. So is it payment systems? Is it currency? Is it legal tender? Is it bank issued currency? And quite famously, one of our most recent members, newest members, had adopted and then right now have reversed Bitcoin as legal tender. And that, of course, created quite a lot of discussion, and then a backing off from the whole payment systems discussion to focus on central bank digital currencies. This question, do you need deposit schemes? Do you need some sort of insurance scheme? What sort of trust is there in that system? It was a very fascinating discussion because it did impact at a point of time a member state. Now, of course, that situation has changed and that decision has been reversed. But at a point of time, it was a fascinating discussion about what legal tender status meant, what privileges did it carry, and so what criteria did it need for there to be, let's say, the ascription of this status to these sorts of say, media of exchange or payment systems, let's say. So that's maybe something, just a little interesting tidbit there. I'm going to turn perhaps to Dr. Fernández Ordóñez and see if there's anything he'd like to add to the foregoing discussion.
No, thank you.
No, that was a nice note. Would anyone else like to talk about this before we perhaps move to a section I'd like to hear from our speakers about for collaborative strategies? Please, I see a couple of hands. Please go ahead.
I want to make sure that this works. Thank you very much for this and for leading this discussion. I think the legal tender issue is sometimes we confuse mandatory acceptance with legal tender, right? And I think we need to draw a distinction between these two concepts, regardless of what terms we use to represent these concepts. There is the concept of being able to use this means or instrument as a way to extinguish debt obligations, which is to say, if I've gone to the restaurant and I ate an entire large meal and then they say, oh, we don't take your payment method, sir, then I say, well, I've got cash. Then basically the option that they've got is to say, well, we're going to call the police even though you left us this cash and we could sue you for it, but at the end of the day, you're just, the law is going to make me accept the thing that you gave me anyway, so maybe I won't do that. Versus mandatory acceptance, when I go to the pub and order a pint of beer and they say, oh, I'd like, €5 or whatever, and I say, well, here's my cash, they could say, well, we don't take that one, and then that would be just fine, perhaps. I mean, this is a separate question, and I think we should tease out these two questions from what they are, because I think we haven't really spoken about the elephant in the room, which is acceptance of cash in Europe and around the world. And that is the reason, I'm hypothesizing, conjecturing, that the reason that we have digital currency is that we need a way for people to have this bottom thing, this thing that they can possess, and have it be accepted. And this is the problem here, is that we see that with the emergence of these inside money methods that are based on accounts, we don't have something that everyone can access, and people are being refused. If I don't have there are coffee shops in London, for example, where if I don't have a relationship with a bank, I cannot purchase anything there. This is a real problem for economic efficiency. Thanks.
Thank you. And anyone like to react to that, including online? Oh, yeah, sorry. Panos, please, you have the floor.
Thank you. This observation hits the nail on the head. Mandatory acceptance is something that the legislator in some jurisdictions, I do remember the Netherlands, has already granted to bank transfers. They do have no extinction of monetary debt, and therefore also mandatory acceptance. But if I were a private issuer, an issuer of private means of payment, I would actually not want the curse of legal tender to befall upon me, because legal tender comes with a public good notion and the guarantee that you need to print it, maintain it, continue it, and have it always available. A private operator makes decisions on their clientele based on their financial surface and good standing, and it makes decisions on which means of payment to continue or which one to discontinue based on their uptake in the market, the risk, etc., etc. A central bank doesn't have that option. Thank you.
Thank you so much.
If I may, on the distinction between legal tender and monetary acceptance, I'd like to use the example of the US. As we know, banknotes in the US write in very clear terms that it is legal tender. And yet you had to have New York legislate into law that small shops would have to accept cash, because it turns out that in a bunch of US states you cannot pay with legal tender anymore. And so I think it's indeed an interesting distinction to look at. And why is that the case, that in certain instances, this legal tender, which we assume needs to be accepted, is not?
Thank you very much. Is this in reaction to this or different?
Just another word of caution.
Please.
About legal tender and its application to deposits. If you grant legal tender to deposits, you risk making foreign currency deposits legal tender, which of course you don't want. So you may wish to make the currency legal tender, but then what about stable coins backed by safe assets? Why refuse legal tender to them?
Thank you.
There's a distinction between legal tender doctrine and the mandatory acceptance, because I think the mandatory acceptance is in the legal tender concept, in the idea that I think legal tender is only an obligation that applies for the discharge of debts. So if you have a pre-existing debt and then somebody comes along and offers cash, they must accept it. But in the coffee example, you go up to the coffee shop, if there's a sign that says no cash, it's just a contract. And it's up to the seller of the coffee to suggest the terms, and they don't want cash. I take your point. There's a socioeconomic impact that falls heavily on the bottom part of society. But I think the doctrine of legal tender has a mandatory acceptance in it in a limited way, but not in any sort of broad way.
You see, when I meant legal tender means something different for everyone, and yet it's literally the demonstration of that.
Thank you. Just for those online, because it's difficult. I'm sorry. I'm not interrupting you. I'm just helping those online because they cannot see each of you. So we're going to take a comment in the room. Go online to the IMF. I don't know if Sandra wants to quickly react because she's on the panel.
I just wanted to ask for whom and in which cases does it matter?
I'm sorry,
what is
but
legal tender?
Please.
The term is hugely confusing because it is used very differently in different jurisdictions. There are three theoretical traditions in legal texts on money. The German concept, the French concept, and the English concept of money have very different derivations. Legal tender is indifferently used to suggest different things under different systems. But just in a nutshell, remember, mandatory acceptance is based in a 1605 case in the United Kingdom, which forced people to accept debased Irish currency denominated in pounds. Then the notion of currency is based in a 1658 decision, which said that banknotes issued monopolistically by the Bank of England at the time are not legal tender, but currency in the sense that they are fully negotiable and bearer instruments, and accordingly, title passes with simple surrender. This is a quite different notion. And then legal tender proper became an important issue during the Napoleonic Wars, because revolutionary France introduced a public law which contained both the Elizabethan element of forcible state enforcement. You need to use the national currency. If you don't use it, assignats. There were no paper money issued by the revolutionary governments. If you don't use assignats, you are a traitor. We'll execute you. This is quite different from the English notion of legal tender as developed by Nussbaum in the United States, by Mann, where legal tender is a private law concept. Now, the problem is that in Europe today, both regulations, both the draft legal tender regulation and the digital money regulation, essentially reintroduce the French element of cour forcée, the revolutionary element, the public law element, and they say that by offering in discharge of a debt or in payment of the price in a face-to-face transaction, digital euro or cash euro, this has to be accepted. And I point to the digital euro draft regulation. If I'm not mistaken, it's Mr. Papapaschalis' Article 5, isn't it? Article 5, which effectively provides, it's a very tricky one. It says this is legal tender. But then it does not say it is legal tender in the sense that it is full discharge, offering it is a full discharge of debts. No, it says something else. That national authorities must be appointed, must be nominated, which must enforce the rule, which means that they must take public law enforcement means, either fines or criminal penalties, against people who don't accept it. But why should this be? I'm a bit skeptical about that. If it already discharges the debt, if I can offer it to you, and if you don't accept it, you just don't get your money, why should there also be public enforcement? This is something that I find a bit, but Rossa, I'm sorry, it is also a public law concept in Europe. I mean, it is quite clear, it is explicit in the law.
Thank you. I'm going to, at the risk of
I'm sorry.
At the risk of immediate execution from the IMF, I'm going to ask if Dr. Rossi wants to respond, because I think it was a response to his. Would you like to?
Yeah, indeed, what you describe is very much a French law approach to this concept, which is you have to accept it. What is the benefit of it? If you look at CBDCs out there and the take-up of CBDCs for the 3 CBDCs that are live, you will understand that so far the success is simply not there in terms of take-up by the people. Legal tender could be one of those additional elements that would bring comfort to the users as to the benefit of the CBDC as opposed to commercial bank deposits. Thank you.
Thank you very much. And then thank you very much for your patience. Dr. Miccoli, you have the floor.
I'm not a legal expert, so I'm not going to chime in about the definition of legal tender. I just wanted to point out that the fund recommendation is not to grant legal tender or official currency status to any crypto asset. So that's usually the fund policy for these things.
Thank you, prudent indeed. Would anyone else like to comment on this point on legal tender? Or have any reactions here? I should look to the sides actually and online as well. Fortunately, I only have two eyes and half a brain. I see there's one there, please. We're going to have the microphone. Dr. Ferry's coming round with it. And there it is. Thank you so much, Chiara. You have the floor.
Thank you. The whole idea of well, monetary policy is based on credit. That the whole idea of banking is basic of the need of credit. And why should we have CBDC separate from credit, and therefore what we should have a CBDC separate from banks? What's the whole idea? If you only need some means of payment, you can only efficient issue regulation regarding payment systems, and don't enter in this whole issue of CBDC. So why do you address the need of separate CBDC from monetary policy? What's the relationship with CBDC and monetary policy and credit?
Thank you. Question there? Anyone would like to? Thank you, Dr.
The
Rossi.
role of central bank money in payment system is present today. As the former governor of Bank of Spain explained, you already have central bank digital currencies, just its reserves, okay? And in order to ensure settlement finality between banks paying between one another, what you have is the RTGS today. And therefore, in order to protect payment systems, in fact, it's a recommendation of the CPMI that whenever possible, you should settle your payments in central bank money if possible. And therefore, it's really to bring more certainty as to the finality of the payments and to ensure more security in payment systems themselves. That's why currently central bank money operates at that layer of the payment system. Now, if you do retail CBDC, of course, there will be a new role for central bank money outside of banknotes currently. And here you might ask yourself, indeed, what would be the benefit of retail CBDC as opposed to, let's say, bank deposits to be so widely accessible?
Thank you very much. Now that I'm actually looking, no one's asking for the floor. No, okay. I'm not seeing any other response. Yes, we do have one. Thank you. Please, go ahead.
So let me just look at financial stability issues from somewhat different perspectives. Whether we should allow non-bank PSPs to access central bank credit. But before I do that, let me explain that access policy around the world. the Bank of Japan will allow non-bank PSPs to open reserve accounts from November this year. And first non-bank will be TransferWise. Wise Payments Japan will become the first non-bank payment service provider to open accounts at the central bank in its history of 150 years. So it's going to be a big deal for us. But at the same time, the BOJ said, not officially, but what I understand is that it's not going to provide access to credit facilities. So here's not, this earlier discussion about governor mentioning level playing field and things like that is in terms of access to central bank accounts, yes, commercial banks and non-bank PSPs are now equal. But when it comes to the issue of access to central bank credit facilities, there's no level playing field yet. And the reasoning behind that is that non-bank PSPs do not inherently have vulnerabilities on its balance sheets. So there's no maturity mismatch or the short-term the collection of deposits and long-term credit expansion, and this kind of the things doesn't exist in when you look at TransferWise balance sheets. So this was the argument or the rationale why the central bank is not really willing to provide credits to non-bank PSPs. But I think this idea, the principal access policy, in our case, it goes back years ago. That it was built based on without the presence of Lombard facilities, and I'm sure many of you know the essence of Lombard facility is as long as entities have eligible collateral, they should have access to a central bank credit. Without, central bank asking them, what's the purpose of, we providing you credit, why is this? And this kind of questioning doesn't exist in case of Lombard facilities. You have automatically get funding as long as you have eligible collaterals in JGBs or, whatever you name it. So, this spirit, the existence of Lombard facility does not seem to be in line with, the fact that, central banks are trying to differentiate this access to the credit policy between banks and non-banks. And I think TransferWise, they also have account at the Bank of England and the Reserve Bank of Australia, and we will be, third or fourth, central bank that they manage to open the central bank campus. But I don't think none of the central banks have decided to provide credit to TransferWise, although those central banks all have Lombard facilities. So there seems to be some kind of discrepancy in between. I was wondering if any of the panel members have anything to say about this.
Thank you. I'll join in the wonderment as to whether the other panelists have something to say or react to this. Yes, so from the floor, please go ahead.
Can I just add that I fully agree with what has just been said, but point that in the past, not so distant past actually, central banks had been very reluctant to play the role of lender of last resort at a penalty rate. This position is in contradiction with Bedford's rules, as you must know, but that's a fact. And the Lombard rate is a penalty rate. Another point which you didn't mention, but I think also which is questionable in the position of central banks, is that they can grant access to non-banks to central bank money, but they do not pay interest. Never mentioned that. You can have an account, but you get 0 interest rate, which of course does not improve very much your situation on the money market in comparison with banks.
I would like to add that if you look at the precedents of March 2020, for instance, and basically the freezing of the debt markets back then because of COVID, if you look at my central bank, Banque de France, even though it did not extend credit to money market fund, it bought tremendous amounts of commercial paper and certificates of deposits from those money market funds. And therefore, if it's not a lender of last resort, in that case, it was a market taker of last resort. And so, yeah, it did not actually grant credit, but it took those assets away from those institutions, which it's kind of the same.
But what if the interest rate is negative? Then if it allows those institutions to deposit money, then they are paid zero interest or what?
For money market?
Yes, yes. So if the key interest rates are negative.
The Lombard facility is the same for everyone, I guess.
Right, I'm not seeing any further reactions. So just keeping in mind, we're now exactly at 12 noon, and so we have 15 minutes on this round table. Might I suggest that we just have a quick touch onto the future, which is what we're discussing over the last 3 days, essentially. Now, I won't pose each of the directed questions, but I'll perhaps just go down the line and ask each of our speakers to maybe look at a specifically forward-looking issue, give their opinion perhaps on where that's going, and provide us with a concrete proposal. And I think that might be a bit of a stretch to squeeze us all into 15 minutes, but perhaps we'll try that. Let's try online first, and hear Dr. Araújo. Dr. Araújo, are you with us? Yes, please go ahead.
Yeah. Well, yeah, actually, if I could define what the future that we are trying to build here in Brazil is with a single word for the financial sector, this word would be inclusive. Digital technologies allow regulators to build open and efficient financial markets, to make it accessible to all parties, to bring contestability to the markets, to avoid monopolies, and the inclusion of the population in the services is a possible outcome, but it's not an assured one. That's the main concern that we must keep in mind. Regulators must work with market participants, incumbents or entrants to promote this inclusive financial environment. Otherwise, we won't get this positive outcome that I wish for. Thank you.
Thank you very much. Dr. Marcello Miccoli.
Thank you.
Would you like to share your thoughts?
Yes, I'll try to be very brief. So first thing, I mean, I think in the future, we need more multilateralism. I think even more than we need now. Digital money, we discussed before, they were born, crypto assets, they were born without a country, and they're made in order to go across countries. So if we want to effectively talk about them, we need to more coordinations. And for instance, one of our point is always that we need to establish collaborative arrangement between supervision and enforcement, international collaborative advancement to enforce supervision enforcement of crypto asset regulation across the globe. It's something that we really need for these things. But then we also need collaboration among central banks. Now, in this, I've not been here at the beginning of the discussion, and we've seen that we've been jumping a lot from crypto asset and CBDC, but those two are very different objects. I don't want to lump them too much together, because otherwise I think we risk confusing ideas of what is something that is public and issued by the central bank and what is something that is private and has completely different objectives. But in terms of multilateralism, I think it's important also when we talk about CBDC, the central banks need to collaborate, because also a foreign CBDC could be used as a means of payment in the foreign countries. And so countries need to collaborate and make agreement with the CBDC issuing country in order how to maybe limit the diffusion of this CBDC on foreign countries. And something that we need collaborations on that, and we need fora to discuss that. And then actually similar to what Fabio was saying before, how do we see the future? Well, I think it's very interconnected. With the world and internet open interconnection in terms of ideas, in terms of talking to people, just what we're doing today, me sitting in Washington, Fabio in Brasilia, and you in Florence would not have possible 15 years ago, or maybe 20 years ago. The technology was still not allowed that. Now we can, But money and assets are still segmented. This is also true to regulations, but also true because we didn't build a system that would allow for such synchronization, such flow across countries. So what I hope for the future is to have a more interconnected world with money for digital assets, making sure that these things actually are done properly and do not endanger the stability of the international monetary system.
Thank you very much. We come back in the room then. We're just going to go tic-tac-toe. I think we start with Dr. Panagiotis, Papapaschalis. I'm trying very hard, but I'm afraid I just don't have the vocal cords. Thank you, Panos. What do you think?
Thank you. So a major, I think, concern is governance. And governance in 3 levels. You do have the governance at the country level, at least in Europe or at currency area level. In Europe, we would have a scheme, and therefore the question is who the scheme governing authority should be. For the central bank, obviously, it should be the central bank because it is a competence to issue the currency. But you need to find a way to involve and introduce the stakeholders. And, contrary to what happened in an RTGS, a classic RTGS, where you only had the participants, here you have the participants, the final user, the acquirers, the merchants, the standard setters as well. And all of these need to function together if the retail CBDC is to function. Then you have governance in the international level. Agreements in order to make CBDCs interoperable, agreements in order to make CBDCs distributable from one jurisdiction to another. Not a lot to say here because unfortunately, as it has been stated before, we first started with an own country or currency area CBDC, and then we integrate rather than going top down, despite the good work done by the BIS on the matter, which is experimental, of course. And the last, which I think people forget, element of governance is governance at the level of standard setting. If there are to be open standards, how will the central banking community, which will have a stake to the development, the change requests, change release, safety of the standard, have a say, and how is it going to be involved in this process? The future, for all the actors involved, it would be an existential matter. And I don't know if it's going to be an existential crisis or an existential question. Thank you.
Thank you very much. On that existential issue, we just, after a whole ballet yesterday, when I realized that someone of a pretty good age was better athletically in athletic form than I've ever been in my life, I figured a bit of micro exercise. So I'm going to turn my head over there. I'm going to ask Dr. Marino Follenweide for his opinion.
Well, I tried to think of something funny to say, but then I was reminded that central bankers are boring in nature, and I don't know what that means for the central bank of central banks. So I think I didn't then try to go there. So I think I just kind of repeat the IMF statement around collaboration, coordination, the increasing need for that, and it's a challenge, but I think it's important. It's vital to have that. With regard to the future, again, nothing funny, but I think adaptive, I think, would be the word that comes to my mind. There's so many changes out there still. I think there are so many stakeholders that drive the different needs from society, needs technical improvements, technical advancements. So as with the future, it's always a little bit of a problem, but I would go for adaptive, and I think all stakeholders need to be somewhat adaptive, and I think key again is collaboration. That not only means collaboration between central banks, but really kind of throughout the chain of market players.
Thank you very much. Then a micro exercise backwards to Dr. Sandra. I'm going to try this again as well. Schweljek, I'm sorry about this. Please, what do you think?
It's much better than Swaljek. Many people call me. Congratulations. So, I don't know. I think that the Pandora's box is opened, and we see a lot of monies floating around, and that is how it's going to be in the future. I hope that the CBDC project ends up successfully, although I see many obstacles to that from different stakeholders. You know, the merchants, the banks, the media, with the fake news, the politicians, I don't know. But finally, and here I will quote Minsky from 1986, who said that everyone could create money. The problem is to get it accepted. So I hope that one day the CBDC is created, it will finally get accepted, and that nothing else will fill this ground before. So that is my hope, and I really keep my fingers crossed. And I see the big competition from cryptocurrencies, and here I will go back to the public, to the consumers. It is very surprising for me, but according to some surveys, questionnaires, in my country, 16% of people already have used cryptocurrencies as assets. That is quite a large percentage, and many of them deem that they own money, not an asset. And the situation is quite similar in neighboring countries, in Slovenia with 17%, and in countries neighboring to us but outside of the Eurozone, Montenegro, 20%. So I see a big challenge here, because those people think that they have money, and now the digital euro will one day compete with their cryptocurrency. And I think that we have a big communication challenge ahead of us, so as to convince people that they have assets, not money, and money has different characteristics. Thank you.
Thank you very much. We go to Dr. Arthur Rossi.
Thank you. Especially when it's in the future. So I think I would like to use one of the things that the IMF colleague said, though, which is the one of interconnection. It seems that our societies, people, are getting more and more interconnected these days. And when it comes to the solution, I think a great solution when it comes to assets and money is to indeed put both the assets and money on the same ledger. And for that, a project like Project Agora, I think, is a shining example of a new type of interconnection that will allow individuals, institutions to transact in a way that is faster, more efficient than we've ever seen before. Thank you very much.
Thank you. And then we go to Dr. Miguel Fernández Ordóñez.
Well, I think that, well, first, my admiration for the BIS and all the people that is trying to build all these experiments and projects. But I think that we are entering in a different era with Trump. I mean, I think that we are going to see many different positions and different ideas. Well, it's clear, no, now, MiCA in Europe is totally different with the executive order of that, completely different. And behind there you have not only an intellectual debate that is fantastic, but also a battle of interests. I mean, then I think we should not lose this idea. I mean, in the United States, until 2 years ago, the main lobby convincing senators was the banks. But since 2 years ago was crypto. And then you imagine that in which could be interested crypto and banks. Well, no CBDC, please. It's clear, because no then, and MiCA, well, with, you see also the banks in my I am suffering because I think we are not going to have a strong, stable coin in euros because you have designed something to defend from Americans. Then we are entering in a very volatile situation, and I think that we should see the good things of this is that we could see the experiments. We could see what happens not having CBDC or then it's well to see something positive that in a world that I think is changing.
Thank you very much to the panelists for all the insights. We're standing 1 minute before we have to close this session. And because it's a Saturday and the sun is shining, I'm going to ask our panelists and everyone in the audience, if you had one word in any language, but one word to describe the future of digital money. So what we've been describing over the last 3 days, one word, what would it be? And just quite quickly, why? Just going to look around. Please, Dr. Sandra Sval. Yeah, I'm going to butcher it. I'm sorry. Please go ahead.
Thank you. I have prepared it, so I can shoot immediately. So if I had one word, and I'm a central banker and I am an economist, I will pick stable and stability. Mr. Carstens once said that the soul of money is trust, and the trust in money comes from its stability. So what I would like to have is a stable money and stable digital money. Thank you.
Thank you. We have stability. Anyone else? Yes, Dr. Rossi.
For me, the one word would be efficient. If you look at the history of payments, it's a very clear correlation between the newness of a payment system or payment actor and the efficiency of that very payment. And therefore, the one thing I would expect from those new payment systems that we're working on is for it to be more efficient, to be cheaper, faster, more transparent, and bring all those good social goods, public goods to society. Thank you.
Thank you. We have efficiency. Yes, of course.
I don't know if free market is a word because it's or not, or two words, but I think free market is the future. Now we don't have stability, it's impossible with deposits, and we don't have competition, as it's important to have innovation, and free market could get that.
Thank you. A hyphenate free market, so that would be one word. Panos, would you like to get a shot at this?
Could we also hyphenate public good? Otherwise, I'll go with equity. I mean, in the end, we do all that because we are supposed to offer a means of payment which is available to everyone, to the ones that cannot afford or are excluded from private means of payment for good or bad reasons, and which should always be available.
Thank you. Anyone else, including online? Dr. Miccoli?
I spilled my beans before when I said interconnected. That was my word.
Thank you, Dr. Araújo.
Yeah, the same with me. I think that inclusiveness, an inclusive financial system is what we can build out of this technology of digital money.
Thank you. In the room. Microphone is traveling. Thank you, Dr. Ferry.
If I may, coming from another field, I would add collaborative with other technologies and open to new improvements in the social developments.
Thank you very much. We have collaborative and open. And we're going to close it there unless we have something else here. Okay, just quickly the word, and I think that there's a bunch of words here. So it's a word cloud. We're going to take that word cloud quite quickly. Let's go.
Politics.
IT risk. IT risk.
Self-custody.
Thank you very much for all of that. One more? Yes.
Essential.
Essential. So we've heard words from stability to efficiency to essential to three, well, all hyphenated compound words. We've got our work cut out for us, I think. But on that note, would you join me, please, in thanking our panelists of the roundtable today? Thank you very much as well. And thank you very much to the audience as well. Your participation made this a lot more fun, at least for me. So thank you. I think Professor Zatti wants the floor back, please.
Yes. Useful to say it was really interesting. I have a lot of food for thought, and at the end you are going to know what is my food. But in the meantime, I have a couple of words. Mr. Ambassador was taken in a meeting, so didn't come. And also Helmut Elsinger, had the same mistake as for currencies, the same mistakes. So for financial instability, I mean, obviously. Dr. Helmut Elsinger fortunately informed us 2 days ago that due to health problem, couldn't join us. So my pleasure now is to conclude this session, this final roundtable, with a closing keynote of a person we admire, Rosa, Giovanna, and I admire. As you can see, it's not the case that we have two women from the keynote speech and the final closing keynote was chosen. Is not the case. And after the closing keynote, my very, very short food that I'm